Hello and welcome back. In our previous video, we explored one of the classic statistical arbitrage strategies, which is pair trading. We broke down what pair trading is, how it works, how high frequency traders profit from it, and even I walked through a Python example step by step. Even I have given the Python code in that video also. If you have not watched that yet, make sure you can check it out fast. The link in the description below. Today, we are diving into another powerful startup strategy, which is index arbitrage. We'll see what it is, the exact math behind it, how traders exploit the tiny price mismatch between an ETF and its underlying stock. Plus, I will show you how to code this in Python as well. So let's quickly start index arbitrage. Before we understand index arbitrage strategy, let's first break down three important basics: index, constituents, and ETF. So first, what is an index? An index is simply a benchmark that tracks the overall performance of a specific group of stocks. For example, the S&P 500 is an index that measures the performance of 500 of the largest publicly traded companies in the US. So when people say the market is up today, they usually mean the index like the S&P 500 has gone up. Second one is, how does an index have constituents? Each index is made of constituent stocks. For the S&P 500, these 500 companies each have a weight in the index, usually based on their market capitalization. So big companies like Apple, Microsoft, and Amazon have a higher weight and influence the index value more than smaller companies in the list. Now the third one is, what is an ETF? An ETF or exchange traded fund is basically a tradable security that aim to replicate the performance of an index. Because you can't trade index, you can trade ETF. Think of it like a basket. It holds the stock of that makeup in the index in the same weight. For example, SPY is an ETF that tracks the S&P 500. So instead of buying all 500 stock yourself, you can buy SPY and instantly get exposure to the entire index in one trade. So in summary, an index shows the performance of a group of stocks. The constituents are the actual stocks with weights, and the ETF is a tradable version of that mirrors the index. So now you understand what is an index, how does an index have constituents, and what is an ETF. Let's see how traders use this relationship to find arbitrage opportunities and make money with index arbitrage. In simple words, index arbitrage exploits the price difference between an index-based ETF, says the SPY, which track the S&P 500, and the actual basket of 500 stocks that makes up that index. So if the ETF price drifts above the theoretical value of its constituents, traders sell the ETF and buy the underlying stocks, or vice versa, locking in a profit when price converges. Let's understand this index arbitrage concept with an example. Let's say an index XYZ constituents of 5 stocks A, B, C, D, E. As you can see on the left hand side, the stocks A, B, C, D, E, and the price A is $100, B is $200, C is $150, D is $250, and E is $100. And then their weight is 10%, 20%, 15%, 25%, and 30%. If you add all these weight, it will come to 100%. It means that the index XYZ constituents of these 5 stocks only, A, B, C, D, E. Now, what the trader will do, they will simply calculate the fair value of each stock. So the fair value of each stock is basically the price into weight. As you can see, for the fair value of A is price $100 into weight 10%, that is the fair value is 10. Similarly, for B, the fair value is 40. For C, the fair value is 22.5. For D, the fair value is 62.5. And for E, the fair value is 30. So if you add all these fair value of each individual stock, then it is coming $165. So the fair value of the ETF or the index is 165. We can't say the index because we can't trade index, so that's why we say fair value of ETF is $165. Let's say the ETF currently trading at 165 0.02, then there is a arbitrage opportunities. So what the trader will do, they simply sell the ETF at $165.02 and buy all the stocks, all the 5 stocks at their proportionate weight at the same time. When the price align moments later, they unwind both the legs, make a profit of 0.02. Now this is for one quantity of ETF. Now imagine if they trade with thousands and thousands of ETFs, then you can imagine how much profit they can make here. Now let's understand the same math for the real trading world S&P 500 index. So as you know, S&P 500 index constituents of top 500 stocks in US and the ETF is called SPY. Now as you can see here, on the left hand side, the stock Apple, Microsoft, Google, Amazon and many more, for total 500 stocks in the left hand side, and then there is a price for each stock. For Apple is $200, Microsoft is $500, Google is $180 and Amazon is $220. It's the same for other stocks as well. Then the weight, like Apple is 7% of S&P 500 index, Microsoft is 6% weight, Google for 4% weight and Amazon is 3% weight. Then you need to calculate the fair value for each stock. Like let's say for Apple, 200 into 7%, which is 14, Microsoft is 30, Google is 7.2, Amazon is 6.2 and for all other stocks as well. So you need to calculate all these things for all the 500 stocks, and if you add up all the weight, it will become to 100%. So let's say if you did all this math for all the 500 stocks and you got the fair value of all the 500 stocks is 505, and let's say the SPY is currently trading at 505.20, then there is a arbitrage opportunities of 0.20. So what the trader will do, they simply sell the SPY at 505.20 and buy all the 500 stocks proportionate to their weight, which is 505, and book a profit of 0.20. Now this is for one quantity of SPY. Now imagine if they can put thousands of quantity. Now imagine how much profit they will make. Now let's talk about some challenges that HFT firms face in the real world when they trade through index arbitrage strategy. Number 1 is execution risk. Price must be matched instantly. Any delay will kill the profit. Second one is transaction cost. As traders trade thousands and hundreds of quantity at once, so commissions and slippage is actually matters a lot. Third one is market impact. Large orders can move your price. And the fourth one is technology. As we know, this is not for the retail traders, this is for the HFT traders. So the HFT traders or the firms, they put a lot of money into technology. It requires colocation, direct market access and smart routing system. Now hope you understand the concept of index arbitrage strategy, how HFT firms make money through index arbitrage strategy, and what are the challenges the HFT firm face in the real world when they trade through index arbitrage strategy. And finally, if you want to build a trading system for index arbitrage strategy, what are the points that you should keep in mind before you build your trading strategy. In the next video, we'll talk about one more statistical or startup strategy, which is PCA arbitrage or principal component analysis arbitrage. Thanks for watching this and see you in the next one.